So welcome everyone to our next episode. This one is a big one. We've had the 2026 federal budget delivered just last week, last Tuesday, and I'm personally calling it a blockbuster budget. I think this is probably the biggest budget we've had in terms of announcements of policy and tax reform in particular, probably for a good 20 years. I've got Alex with me again. Welcome, Alex.
Thanks, Venkat. Welcome.
So this is going to be a very interesting one, I think, because we've got a lot of the sort of things that we talked about in our previous episodes. Some of these have come to life. Now, of course, things may change again as it goes through the Senate and the politics plays out. But we've got a couple of very major changes. Let's talk
Correct.
just about the CGT and negative gearing stuff in this episode, because there's other stuff
Yeah.
that's really important, which we need to leave for for a dedicated episode. So the first thing I think we should start with is overall, what do you reckon, particularly in terms of negative gearing and CGT changes? What's your opinion?
I think that, for a lot of people that
Mm,
have existing properties and that were focusing on the benefit of negative gearing and, if you like, the benefit of disposal and getting 50% discount, not that much has really changed.
yes.
And I've always had the view that why do we negatively gear from a cash flow point of view anyhow? Because you're
Mm,
running a negative cash flow
mm,
and you still, even though you get a tax refund, it never covers the cash flow shortfall. So
correct.
financially, it never made logical sense, to be honest. So I
Yep.
think this changes people's thinking about how they structure and how they buy investments. And one of the things I think we've discussed before, Venkat, off
Mm,
screen, was to say that negative gearing is only about residential property. What about other types of property?
that's exactly right. That's
And
exactly right.
it broadens the uh, avenue for people to look at commercial property or whatever, maybe or
Yeah,
shops, what it be. So it's you can
precisely.
still and it's like all reforms.
Mm,
Everybody worries and panics when it first comes out, but then you sit and think about it for over a week and say, how do I get around it? Because
well,
we're in that
and
space.
that's right. And look, it's not always all bad either.
No,
And my view personally is on this is that I
yeah,
think they've actually done something that they should have done a very long time back.
yeah,
If in fact these changes result in house prices becoming lesser, or if there's a reduction in house prices, that's a
correct,
good
correct,
thing for everyone. If housing becomes more affordable, if more people can afford to own their own homes,
right.
overall the economic benefits will outweigh the costs.
And I think if we're trying to help the next generation, the generation of to acquire a home at a
Mm,
reasonable fair price,
mm,
well, yeah, we've got to take a hit somewhere along the line to help the future.
correct.
We can't be selfish in our own regard sometimes.
Yeah,
Yeah.
yeah. And in fact, some people would say that what was proposed in the budget actually hasn't even gone far enough. And partly some of that's true because as you
Yeah.
mentioned just a moment ago, for anyone who's got a property as an investment property right now, nothing really changes. You continue to do your negative gearing for as long as you want.
Correct.
And when you sell the property, well, you've got until 1st of July next year. If you really think that you've made enough money, you want to get out, you can get out. You can collect your 50% discount. So we'll talk
Yeah.
about that in a moment. But
Yeah.
but yeah, I'm not sure that a lot will necessarily change. But at least we seem to be heading in the right direction.
And I think you've also got to remember that when with the old system, which is not going to come back to become the new system, you index cost for inflation. And look where bloody inflation is. It's not 2 or 3%.
Exactly.
Anymore. So we should be encouraging higher inflation as an
Yeah.
investor.
Well,
Always help.
that's right. Well, at the
And
same
it's also,
time, Well, at the same
yeah,
time, if property prices do actually start to fall, that will
yeah,
actually help overall inflation come down,
yeah,
which means the
yeah,
overall cost of living falls as well. So, I mean, look,
yeah,
there's a lot to unpick here. So, let's get
yeah,
into the nitty gritty.
yeah,
And
no,
if we
yeah,
look at the first point here, Alex, the first thing that I'd like to talk about is to do with the CGT discount being abolished.
correct.
So,
Yes.
I've got on a slide here that the CGT discount has been abolished for disposals or sales of CGT assets after the 1st of July 2027. So, on
Correct.
that front, just quickly explain to our audience what that means.
Well, it means up to the 1st of July 2027, we can still, if you like, use the old discount method. All right. And then from that, to work out a capital gain, we have to use the indexation method. So
Yep.
we're going to have a transition phase. And, all it does, to be honest, is depending on where inflation is, it might make a small difference and we might have to pay some more tax. But at the end of the day, what we're also hoping for is that, if the minimum tax is 30%, we also hope that as part of the overall plan that going forward that they also drop the tax rates personally as well. So that, even though we have a minimum of 30%, if you're on the 47, it's still pretty high, but you try to transition it such that hold and sell when you're on a lower tax rate. And that's always been the strategy for a lot of people, to hold investments, get the benefit whilst the working of gearing, and then when they retire, then dispose of the properties or just live off the income, whatever it may be. And it may very well be that people that were thinking of disposing in the future now hold and rely on the income from that investment rather than the capital that they used to think about in the past.
Well, and it actually might encourage longer term rentals as well, because you might want to retain your good tenants, keep them there rather than just keep putting the rent up and trying to get the next person in.
And I think the idea of rental, I think the only issue about rent is really all the state government changes that made it more difficult for landlords.
Particularly in Victoria,
Yeah, Victoria particularly. Well, if you're living in other states, probably it's not so bad.
It's not so bad, correct.
State issue, and maybe come November, we'll find something different in Victoria, potentially.
Exactly. And look, I think just as a reminder to everyone watching, the CGT discount basically means if you sell, let's say, your investment property and you made 100,000 on it as a profit, half of that profit was tax-free, so that's called a 50% discount. Whereas what will happen if you sell after the 1st of July 2027 is that up to 2027, you'll be able to claim 50% off the profits as tax-free, and any profits made from 1st of July onwards, 1st of July 27 onwards, you will have to use indexation. So you will need to get a property valuation on the 1st of July 2027. So if you're a property valuer out there, you're probably licking the chops, because there's a lot of work going to come your way by the end of next year.
That's right. And I think the thing about property valuation is that you can't do the cheap and nasty and get a real estate agent. I think the rules will be in the past is to get a qualified property valuer to value the property, and depending on what the market is, value high.
Yes, I think so, and I believe that the budget papers mentioned that the ATO will also provide some other forms of valuation that they will accept. So they might even make it easier to get a valuation rather than make it more complex. So they might publish a list of sort of approximate values or whatever it might be.
It's dangerous because if they use, say, council rate valuations, they're always lower than the actual market. And I think,
yes. I mean, I think if you're a property investor, you want the council rates used
as possible. So that's why I think if they publish tables, they're obviously going to aim for the lowest possible value. So for a few $100.
Sorry, I'll take that back. If you're the property investor, you don't want the council rates used, because they'll give you a low valuation, increase your gain. That's interesting, and I think that if there are people out there who are sort of thinking, well, I don't want to miss out on the discount. Well, you don't have to. Just sell by the end of 1st of July 27, and and I mean, even if you do the maths, Alex, right? If you get your discount up to 1st of July 27, and then you index after that, unless you were going to hold on to the asset for another 10, 15 years, actually you're pretty much getting the discount anyway.
Correct. Yeah, because I think that would be concerned with those that if you add capital gains and negative gearing, you say, okay, you're high income earner, VNCAT, so you should negatively gear and get the benefit of the tax deduction because you're on the top tax rate. Then if you sell, you say, well, okay, again, but I'm on the top tax rate, even though there's only half of it. So you caught in a conundrum: sell or hold, or just say to me, well, let's just hold till we retire. Okay, my tax rate, minimum is going to be 30. So what? It's not 47. Maybe.
Exactly. Yeah. So it's just a matter of thinking it through and planning it in a way that actually becomes beneficial for the taxpayer.
With all these tax reforms, as you said before, Ben, it's a great time to be an accountant.
It certainly is. I mean, I'm not thrilled about the fact that I've got to go and change all my lecture material for the years coming ahead, because that's a lot of work for us to go, as I'm sure it is for every person out there who has to implement these rules.
AI is not going to help you.
No, because AI is going to
No,
get confused with these new changes, I think,
no,
because they're so complex.
that's why I think being an accountant, but being an advisor, not a doer, is going to be more critical now with
I,
all these changes.
I
Yeah,
think so. And also being able to understand these changes at the sort of policy level, trying to understand the politics of it all as we're doing in these talks that we're having, is really quite important for younger people who are, aspiring to be in this profession going
yeah,
forward.
yeah.
So,
All
leaving
right.
behind the CGT just for a moment, Alex, if we move to the negative gearing stuff,
Yeah, yeah.
so in terms of that, the big change, of course, is that negative gearing is no longer available for new property purchases
Yeah,
after
yeah,
budget night, right? As
yes.
if they are existing properties. So if you buy a new rental property after budget night,
Hmm.
the negative gearing continues to apply the way it always has. So,
Correct.
so a couple of things to unpick there, which we need to look at. First is, as we said, that existing properties negative gearing will not apply to.
Correct. Yeah, so if people like you and me, if we own an existing investment property, life
Mhm.
carries on. All
Mm.
right. If we
Yes.
want to buy another, sorry, not a new, but another investment property,
Mm.
our choice is buy an existing house or new. Now, I'm not sure what new means
I
because
think
it
new, the
could be.
way they've defined it is it's got to be either a newly constructed home on a block that didn't have a residential property on it, or it's where
Mm,
you take an existing property and build more than the number of properties that were on it before.
yeah.
That's how
Well,
they've
I'd
defined it.
say, well, see, my issue is really with a lot of the high rise apartments that you have in the
Mm.
city, a lot of those are vacant. All right. So if I
Yeah.
bought one, is that
Mm.
new? Because it's newly built? It might have been built in the last 2 or 3 years. But if it's vacant, it's never been rented. So I'd sort of take the view
I,
that's
I,
new.
yeah, but I think under the
But
rules they'll
there's
call
not
that
much
existing
built.
because that, yeah. So obviously
Yeah.
all the greenfields developments will all count as new. So if you're out in the sort of outer suburbs with the new houses that are coming up, that'll all count as new. Or, if you're in an established suburb, someone sells their 800-meter block and someone puts 4 townhouses on it, that will also count as
Yeah.
new. Uh, so that's certainly my understanding at this stage. So
Well,
as you said,
it
Alex,
causes, yeah.
sorry, go
It
ahead.
causes concern to me because I sort of think if it's the green fields, a lot of people that buy it, they're new families, young
Mm, mm,
families.
mm,
And you're putting up the same investors against new families issue that we try to get rid of.
mm,
And even
mm.
if you look at developments with closer into the city, again, who's going to be able to buy those?
Yeah, look,
Because
that's a
they're
tricky one.
expensive. Yeah, and that's why I think they've got to think through a bit more
Mm.
about this kind of the new. That's all. Because I think I don't see the problem with established stock. Not everybody wants established stock.
I think there's two things about that, Alex. One is that they found that the data shows that a lot of the negative gearing currently is being done
Mm.
on existing properties. That's the first
Yeah, yeah,
first point,
yeah,
and that there's
yeah.
not as many new stock coming in as a result. So I think part of the reason for saying it's still allowable for new developments is to simply increase the amount of supply of houses. So from that point of view, I think it works.
Mm.
Whether it actually results in new builds is actually a capacity problem. We haven't got the capacity in this country to build more houses. That's actually the key
Yeah.
problem. But
Well,
at least it provides the incentive, I think.
yeah. Well, I think the issue is that if you're going to build new, you're going to have the people that are qualified to build the new. And
Yeah,
sometimes if you don't, this is a real conundrum. Do we bring in people that have the skills? And then it's this whole immigration issue.
well, that's a whole separate kettle of fish, which we
I
which
mean,
we as
yeah,
probably want to stay out of in terms of the tax perspective on things. But
yeah. But I think it's
it,
important people understand that when we talk about tax, it leads on to other issues they've got to think about. And
100%.
they look at this headline, oh, we have new residential projects. You've got to think about who's going to actually build them. And if
That's
we,
our biggest problem.
yeah,
That's our biggest
yeah,
problem. And I mean, historically, we've only ever really managed to do it with migration. That's
correct.
the
Yeah,
historical truth about how it's gone in this country.
yeah,
So
that's it.
negative gearing will continue to apply to existing residential property. So I
Correct.
think,
Yeah,
from my point of view at least, what that
yes.
means is that this whole panic about rents are going to skyrocket simply isn't
Mm,
going to happen because
no, no.
anyone who's currently renting, they're all
Yes.
existing investment
Yeah.
properties. The rules don't change for them,
Correct.
right?
Correct. And I
So
think, as I said to you before, it's only the state government and Victorian issues that have forced people to reconsider rental.
exactly,
And
exactly, and
people,
Queensland, for example, has been an attractive place to have investment properties.
I know. People go there or buy there. And why would you buy? Someone said, why would you buy in Victoria?
Yeah, yeah. So those are really state government issues rather than
Yeah.
And so
But that,
I think sorry.
yeah. Yes, sir. Go ahead. Yeah.
So
Yeah.
I think the idea that removing negative gearing from new property purchases will somehow drive up rents. I think that's an argument that just isn't going to hold up. I think we'll see in history will show that just won't hold up. Even the CBA was saying that prices will increase, but by 2 to 3%, which really is quite insignificant when inflation's already sitting at about 4%, 4.5%.
Yeah.
So the final point I think that we should probably also talk about is that any properties that were purchased before CGT came into place many, many years ago, 20th of September 1985, will now also be taxed.
Yeah. Yes. So
Can you talk us through that one, Alex?
Well, with the changes that they announced, they said that, when the system first came in back on the 20th of September 1985, assets bought before that date, you didn't worry about CGT. All right. And that was always fine. But, look, 1985 to now, what's that, 41 years.
Long time.
So there's fewer assets bought pre-1985. So really, even without that announcement, over time, the people today, our kids and so forth, they're never going to have a pre-CGT asset. So I would think that there are fewer and fewer people that have it. So why not just make it all? And that's what the effect is saying, that, if you bought pre-CGT, too bad you're now going to come under the CGT provisions when you dispose of it.
And that still only comes in 1st of July 2027. So if you were to...
If you time to dispose again, if you wish to, and some people may, disposal can be giving it away to your family or actually selling it. So, if you keep them, yes, give them away, transfer them, whatever. Yes, you pay a bit of stamp duty or whatever, but at least you to somebody else if you want to.
Yep, as long as that doesn't cause a CGT event, of course. So those are some of the changes. I think, Alex, we might wrap this one up there, but all the other stuff, I think, warrants a separate discussion.
I think before there was a lot of reforms, not just for individuals, but also businesses as well.
So we need to come back to those in a future episode, including, of course, the most interesting one for me, which is always trusts. So we'll come back to that in a future episode.
People that have these vehicles.
Absolutely. It's going to be so much fun. So I'll see you in the next one, Alex, and thank you very much.
Okay, we'll catch you later. Take care. Bye.